Welcome back to the Retirement Income Show. I'm Mark Elliott here with well-respected retirement wealth advisor and certified financial planner, Troy Sharp of Oak Harvest Financial Group, a local family-owned firm. You can find out more on the website, oakharvestfinancialgroup.com. Great website, oakharvestfinancialgroup.com. You have questions, concerns. Boy, Troy goes into this a little deeper than I've ever thought of my retirement. I kind of like the sound of this. I'd like to chat with the team, see if they can help me. Give them a call. There's no cost. 800-822-6434, 800-822-6434. The office of Oak Harvest located at 920 Memorial City Way, right off I-10 and Bunker Hill. Most of us think of retirement really as our investments. That's where we were a few segments ago, talking about most people think their retirement plan are their investments. That's their retirement plan. During my granddad's time, who retired in the 70s, he would have had a pension, he would have had Social Security, he would have had certainly high interest rates as well during the Carter days, double-digit interest rates. Easy to put money in a CD, just ladder it. Income was not a problem for my granddad. Now, inflation certainly was, because inflation was double digits as well. For me, I don't have a pension. I'm going to have Social Security. I'm Social Security eligible later this year at the age of 62. Not quite there yet, but getting obviously very close. But that's all I have, plus my little 401k and IRAs. So my thinking is that people like me that don't really understand the financial world like you, and you, the retirement expert that you are, is that I think I probably have a lot of risk, but I know I need more growth. I played too much golf, Troy, so I need to catch up if I can. But I think most people with IRAs and 401ks, we think of, boy, I've got to keep growing my money. I can't put it in a CD like they could in the 70s because I can't make anything there. So I've got to have all of my investment money has got to be in the investment world. That's the only place to make money. So risk, is that a factor that you sit down and figure out? I've heard, well, I'm a moderate, I'm a, this risk, that risk, whatever. I don't know if that really tells me the story, but how do you look at risk?
So risk for us is really threefold. The first two parts are, at least the first one is more conventional as far as how much risk are you willing to take with the fluctuation of your account values. Somebody who has $1 million saved, and this is partly why that low risk, medium risk, high risk question is pretty bogus. If you've sat with a financial advisor before and they ask you this question, it's really a loaded question. And let's say I'm medium risk and I have $1 million. Well, if I change that question around and now say, are you comfortable if your account goes down from 1 million to 800,000? Because a medium risk person should absolutely be comfortable with that. That's only a 20% drop. That's less than the normal drop you would see in the market in a typical recession. So one person, and this has happened to me throughout my career, this is why we don't ask this question anymore as far as are you medium risk, high risk, or low risk. So the first part really is, okay, if you have $1 million and your account drops to 800,000, what is your reaction? Okay. And the gut answer is the best answer. If someone's sitting there thinking about it for a while, typically it's not truly what they do because the instant reaction is the most emotional response. So we need to get an answer from that pretty quickly to really gauge where people stand from an emotional willingness to take risk.
And I would think the answer is different when you say 20% or 200,000. That's a different response.
Absolutely.
Maybe.
Yeah, absolutely. But so that's why I turn it on its head and rephrase the question, and that's how our advisors do here in terms of dollars, because a lot of times people can't compute percentages as quickly in their head as we can, or they just don't care to do the calculation. They hear 20%, okay, 20%. But if I say $200,000, okay, now I have your attention. So but just to finish this thought out, one person may say, yes, Troy, I'm completely fine if my portfolio drops 200,000. Another may say, I have a long-term view. Even if it went down 35 or 40%, I'm in it for the long haul. It's fine. And someone else may say, no, Troy, I will fire you if you lose 200,000 out of my million. Well, those three people have different emotional willingness to take risk. All three of those are not medium risk profile people, but they may all answer that question in that manner. So that's the first component of risk. The second component is what we call your capacity, your portfolio's capacity to take risk. So capacity is a function of how much income you need to withdraw relative to the overall size of your portfolio. So if you have $1 million and you need to take out $50,000 per year and you're 60 years old, that's a relatively low risk from a capacity standpoint, capacity for risk standpoint, portfolio. Because if you take that 50,000 out and the portfolio drops 20, okay, you've now taken 25% out essentially in the first year of retirement. 1/4 of your entire life savings is gone. The next year, now to get that same $50,000 with 25% gone, you're left with $750. To get that same $50,000, now you have to take about a 7% withdrawal, because 50,000 divided by 750 is somewhere around about 7%. So as the portfolio drops in value, your income need represents a larger and larger percentage of the overall portfolio balance. If the markets don't turn around immediately and they fall another 10, 15, 20%, your portfolio declines in value. Now to get that same income need, now you're looking at 9, 10% of your portfolio being withdrawn. And if that's the case, you will most likely run out of money in 10 to 15 years. It's just you've depleted the portfolio to such an extent it is no longer capable of sustaining withdrawals that allow you to maintain your standard of living and achieve the growth needed to regain its prior levels. So that's the second component of risk, is what is your portfolio's capacity for risk, meaning relative to its balance, what is the percentage that needs to be withdrawn? Ideally, at 60 years old, you want to be in that 2 to 3% range. Now, to what you said, Mark, part of this and why we almost have to take more risk unless you get outside of the securities world, part of the reason why so many people feel they need to take more risk is because the Federal Reserve, through monetary policy of printing money, essentially digitally, inventing it out of thin air, using that to buy bonds and then artificially lowering interest rates, what they've done is they've punished savers in this country, essentially. They've punished low-risk investors. Your CDs, your high-quality bonds, your money market accounts, your traditional interest-bearing, low-risk, relatively safe choices aren't going to grow enough to help keep up with inflation and help your money last as long as you do. So part of the reason why you feel that way, Mark, might be because, as you said, where are you supposed to put your money? The only way to, even with bonds, the only way to really get any interest with bonds, you have to look at the junk bond markets, or you have to go into what we call leveraged bond funds, where essentially your money's being put on margin. Essentially is what happens with leveraged funds. So if you see a high quality bond fund out there paying you 3.5%, 4%, dollars to donuts, they're borrowing typically hundreds of millions of dollars to go out and buy more bonds to generate more income for the portfolio and then pass it on to you. Well, what happens to that leveraged fund when things go bad? Okay, instead of losing 5% or 10% of your money, you're likely to lose 15 or maybe 20%. So part of the reason is, of course, where we're at with the damage that the Federal Reserve has done to the interest rate environment in this country. And then the third part there, I said there were three parts of risk, and this is really the unseen risks that most people don't think about in retirement. Most people are solely focused on stock market risk. And yes, that is an important one. But inflation risk, tax risk, longevity risk, so many other risks out there, sequence of returns risk, your distribution rate risk, putting money into CDs and bonds, that is a risk because, again, you're not going to earn enough growth to offset inflation and to have your portfolio have a chance to grow so you don't outlive it. There are so many other risks other than stock market risks that are equal to, as far as the long-term consequence and the damages that can be done to your portfolio and your retirement, such as inflation and tax risk, et cetera, that are equal to stock market risk. 1-800-822-6434. The good news is our Retirement 360 process addresses each and every one of these risks. And at the end of the process, you have a plan in place that helps you feel comfortable knowing that the big questions are being answered. Do you have enough? Can you retire? How long will your money last? Where should you take your income from? Should you take it from the IRA? Should you take it from the non-IRA? Should you be doing Roth conversions? All of this is part of the Retirement 360 process. It's part of the income plan, the investment plan, the tax plan. And then, of course, steps 4 and 5, we look at the estate plan and we look at the healthcare plan. Those are two big components that are often neglected when it comes to a full retirement plan. So there are answers, there are solutions, there are ways to have less anxiety, to feel better about where you're at, and you don't need $1 million or $2 million or $10 million. We help people all the time, $700, $600, $500, $800,000. It's all about how much you spend. It's all about the decisions you make, because every decision you make interacts with every other decision. Everything has consequences when it comes to the decisions you make in retirement, because they're all interrelated. So give us a call, leave a message. If you're listening to the show and it's not on a weekend, or if you're watching the show on YouTube, give us a call. Somebody may answer the phone. We're simply going to talk to you about your situation. If nobody answers, leave a message and we'll get back to you. 1-800-822-6434, 1-800-822-6434. And by calling that number and leaving a message, what that means is you're on your way, taking the first steps to having that Retirement 360 process planned out and a plan in place that answers those big questions for you.
And that's why we kind of are doing a show that's kind of, are you retirement ready, and how in the world do I even figure that out? Well, most of us think about our retirement plan really are investments. That's kind of the key, the 401ks and the IRAs and the like. And if you got some real estate, great. And that's all well and good, because you do need investments. You do need to create income for your retirement. But it's so much deeper, which is why I really like how Troy handles all of these questions I throw at him, because I don't give him, hard sliders on the outside corner. I'm not going to make it super hard for him, but he has got so much response to and passion for what he does for his clients at Oak Harvest that I really like how he goes about this, informing you of how Oak Harvest works with their clients and the importance of, hey, being a nice person. But we're here to help, and you've got to be serious about retirement. So the Retirement 360 process, income plan, investment strategies, tax-efficient strategies, healthcare, long-term care, legacy, estate planning, Social Security, big question. 90% of people get it wrong. Doesn't mean you're wrong at 62 or 70, it just means you're taking it wrong for your specific situation. And that's according to the Social Security Administration. Then that's in the income part, right? That's part of your income, is Social Security. What about Medicare? We know healthcare is you talk about inflation. Last year in 2020, medical costs were up 6%. They were in the inflation rate, and they gave it a 6% score. So we know it's going higher than regular inflation. So what's your plan for that? Well, Medicare's in the healthcare part. Those are all big, big things, and that's the Retirement 360 process. Great opportunity for you to call the team. Be proactive. Don't be reactive. It's 800-822-6434, 800-822-6434. We're headed to our final segment with Troy Sharp, the CEO and founder of Oak Harvest Financial Group. Stay with us. We're back right after this.